day 2 of the meeting. We are midway through the conceptual framework limited scope update item. So Ross, I don't think we have any administrative announcements to make, do we, before we head on with that item?
No, I don't believe there's any administrative announcements today related to that.
Okay, so John, if you can take us then into the discussion on assets.
Yeah.
And just to remind everybody, obviously we do have the specific issue that we're taking away, which is this consideration about whether to move away from the use of the term item to use rights throughout. So that's something that's a separate discussion that we will have at check-in meetings. So if we can take that as read, that's a separate discussion. So John, lead us into the rest of the discussion.
Okay, thanks, and hello everybody, especially to those I haven't spoken to this morning. There are really two components of agenda item 3.2.6. The first is that we've looked at the definition in the IASB's 2018 framework and compared it with the definition that we have in the 2014 IPSASB framework. And whilst there are certain differences in the ordering of words, for example, the IASB uses the term a present resource, and we simply use the term a resource. We attach presently to controlled. The IASB doesn't do that. The two definitions share three common components. They have a resource or an economic resource, control is present, and both require a past, that there be a result from a past event in the IPSASB case or events in the IASB case. We've considered the two definitions, and the view we've come to is that the only very minor change we ought to make to the IPSASB definition is to make past event plural, because the resources can accumulate over time, just as we shall see in discussing liabilities, that there can be one or more present obligations. So the view is that we should have a definition which reads a resource presently controlled by the entity as a result of past events. So perhaps at that point, I could, through Ian, ask for views.
Thanks, John. So can I check whether anybody disagrees with making that change to the plural? Yeah, Lindy.
Thanks. I don't disagree. I was just wondering if the additional wording in paragraph 513 just creates confusion where you say one or more. I think we've made it plural. I didn't think we needed the extra clarification there.
Sorry, Lindy, which paragraph is that?
So it's 513.
Yeah.
So we've made the amendment for past events or past transactions. I didn't think we needed to also add an additional one or more there, because I don't know, I think it could cause confusion around, are we talking about transactions or events? Or...
Right, yeah. So this is in the second line of 513 in agenda item 3.3.2.
I mean, it's consistent, Lindy, with the proposed change on liabilities, where we need to cater for one or more. And so I think it's really just a consistency point that, you know, the proposal is that we move to the use of plural because that's more likely to be the case. It was wanting to cater for the eventuality that we might have just one past event it then made it, consistent, but it also with the ISB's definition, but it didn't create a requirement that you had to have more than one in doing that.
Yeah, exactly.
So if you're okay on that, Adrian.
So this is not on the plural. I'm taking it that we finished on the plural, and if not, excuse me. My issue is presently. Presently isn't well defined. It means different things, and one of the meanings of presently is soon. And you'll find if you search for the definition of presently, you come up with all kinds of recommendations saying avoid the use of the word presently and use currently instead. So I recommend that we substitute that.
Right.
Adrian, I think we've not had any problems with the use of that term since the framework was brought in, and I understand the colloquial issue, but actually this is a formal definition, so I think in order to avoid confusion amongst our users, I think we should stick with presently and not change for currently. There is a lot of investment in the use of the term present or presently. So I think unless it's broken, we should not try and fix it. Okay. So if there's nothing further, then John, can you move us into those, the next items for discussion?
Yeah, certainly. Can we go back to the slide, please, Joanna? Thank you. Yeah, the next aspect is that there is a certain amount of guidance in the ISB framework on the definition, particularly on resources. And in paragraphs 14 to 17 of the paper, I have highlighted 3 areas where we think that the framework could be improved by including suitably modified guidance, which is in the ISB's framework. Now, the first of those is resources that are received and immediately consumed. And if you recall, during the revenue project, there was consideration given to modifying the requirements and guidance on services in kind. And the issue arose of whether, if a service is provided to an entity free of charge or in a non-exchange transaction, whether or not an asset arises. And some questioned whether an asset arose. I think this guidance makes the point that in such circumstances, and the other circumstance which comes from the ISB framework is employee benefit, employee services, there is an asset which momentarily arises until the recipient entity consumes the goods or services. So we've added paragraph 5.9b, and that refers to both employee services as in the parent paragraph in the ISB framework, and services in kind. Do you want to stop there, Ian, or should I go through the other 2?
No, I think we'll just walk through each of these in turn and just check where the board is on the proposed additional change in each case. So
this is paragraph 5.9b in agenda item 3.32.
It happens to be 5.9a in the actual draft framework.
Sorry, is it?
Okay.
Sorry, yeah, that's right.
David and then Camira.
Thank you, Ian. I just point out that the word momentarily has got a different meaning in North American English and English, and I would suggest that the word momentarily is deleted and replaced by briefly.
Right.
Thanks, David. Camira.
Thanks, Chair, and thanks, Jones, for the explanation of this paragraph. Actually, that is also, I have faced this question by practitioners that they, for instance, they receive consultancy services as a donation, and they do not know if they need to recognize that or not. But after reading this paragraph, then it would mean that they will not need to recognize it. So it's not clear because they say, okay, at the end, in the case of consultancy service, they receive a report and maybe they can make use of it afterwards, not necessarily during the service, but also after. So what will be the interpretation in this case of this paragraph? Thanks.
If I could respond to that, this paragraph is not saying that you would actually recognize an asset at the end of the reporting period, but it is explaining that that certain services do give rise to an asset for a very short period.
Okay, so it's generally speaking, it's not like it's not a rule base or anything. So it's leaving it open. So for those entities that consider that they can still benefit of those services or the output of those services in kind afterwards, they could recognize it, and if not, not. So it's just it leaves it open for judgment, right?
I think that's correct. Yes.
Okay.
Yeah, I think when you look at it, Camilla, I would have that same interpretation that it talks about some. So I think that would address the situation that you're talking about. Renee.
Yes, that Camille's point is interesting. To me, you would still recognize the transaction as an in-kind revenue and an expense, right? So the debit would not be an asset, but would be an expense. So the actual transaction itself can be recorded in certain frameworks. There is the possibility of recording it. It's just that here we're saying the debit would not be recorded as an asset. It would go straight to expense. That's how we do it in Canada. And I think that's what we mean here, because we're in the asset guidance.
Yeah, I think practically that is the case. If we look at IPSAS 23, IPSAS 23 does talk about services in kind in terms of asset and expense, but dependent on your bookkeeping system, your accounting system, I think practically it is likely that you would recognize income and expense or an expense.
And I saw thumbs up, Renee, as you were going through the explanation. So I think that works. So are we okay then with the inclusion of the paragraph as proposed? Okay, good. Thanks for that. So John, move us on then to the next bullet.
Okay. The next point is an additional bullet to paragraph 5.7, and this is to note that resources can be used to extinguish or reduce a liability. And I think that this is as appropriate in the public sector as it is in the private sector. So you'll see that there's an additional bullet point which has been added at the bottom of paragraph 5.7. So to ask through you, Ian, if the board is happy with that minor addition.
Okay, thanks. Lindy, go ahead, and Joe, if you can stop sharing the screen, please. I can see. Right, okay. Lindy.
Thank you. I just noted that the IASB's framework, they continued with having a sentence on the obligation, and that the obligation might be that of the principal, not the agent. I didn't see it getting picked up on the liability side, so I don't know if we should also include that here or possibly on the liability side, but it is missing, and it would give the full picture.
Right.
It would seem logical, Lindy, if we picked it up on the liability side. So if we can have a look at it there,
Yeah.
and see what we do with that. Okay, any other points? No, okay, good. Move us on to the final point then.
Yeah, the third point is that currently we don't have anything on the principal-agent relationship. And this is an issue which has cropped up in a number of projects, and a recent example is in revenue and transfer expenses. So I've added a new paragraph 5.12a to agenda item 3.3.2. And what that's doing is noting that where an agent has custody of an item but does not control that item, then it does not have an asset. So I don't think there's anything particularly novel or controversial about this, but I think it is something that is worth making as an aspect of general guidance for standard setting. So if I could ask for a view on that.
So, Lindy, you said your comment is actually on 512A rather than the previous paragraph. But I think probably we're in the same position in terms of we pick it up in the liability side, if that's okay. Yeah. Any other points people want to make on that? Okay, so I think everyone's happy with that, John?
Yeah, that's fine.
Else? Oh, sorry, Lucy.
Thanks, Chair. But I agree with that, but I just suggest that it should be underlined just to differentiate it, that it's a new paragraph. Thank you.
Yeah, thanks, Lucy. Yes, that's right. That paragraph as additional text should be underlined. Apologies for that. I don't know why that hasn't been underlined. So when we issue this as an ED, that will be underlined. Okay, that's good. So if there are any other minor drafting points, if you can pass those to John, then I think, John, that concludes on asset. Well, unless anybody's got any further issues they want to raise, yes, that's right. That concludes it.
Chair.
Sorry?
Lucy.
Oh, sorry, Lucy.
Yeah, it might be a belated comment, but I would just like to, can we please go back to paragraph 5.11, because I think this was taken from paragraph 4.20 of the IASB conceptual framework, but the second and the last sentences of paragraph 4.20 were not considered in 5.11. I think they will provide useful public sector guidance if this will be included. And the second sentence actually is a prelude or a precursor to the second bullet in paragraph 5.12, which specified that the ability, indicated the ability to deny or restrict access to the resource. So, thank you.
Right.
Sorry, Lucy, what were you proposing to change? I mean, I think we have to be very careful that we're not trying to fix everything. We're just trying to deal with the specifics. So what was it that you were trying to change in 5.11?
No, I am suggesting that if we can consider including the second and the last paragraph of 4.20, which states that control includes the present ability to prevent other parties from directing the use of the economic resource and from obtaining the economic benefits that may flow from it. And it follows that if one party controls an economic resource, no other party controls that resource. I think it would be clearer, it would provide clearer guidance for public sector, especially when we identify already the when we try to define what presently controlled by the entity is.
So are you, sorry, maybe I'm not following. Are you asking for repositioning or are you asking for the wording to be moved?
I suggest that it should be included in 5.11 because that was that was not considered when it was in the present wordings of 5.11. That was not considered. But when I check on the equivalent guidance in the ISB conceptual framework, that is paragraph 4.20. Although there is already a second bullet in 5.12, which specify that the ability to deny or restrict access to the resource. But I think if we include the last two sentences in paragraph 4.20, it will give, that would be a prelude to 5.12.
I'm very reluctant to start moving material around. I mean, just because it's in a particular position in the ISB's framework doesn't necessarily mean that it has to be in a particular position in our framework, because this is our framework. And I think, you know, we can all make improvements in terms of logic flow and so on within the drafting. But, you know, there was quite a lot of effort put into this. So, John, unless there is a real fatal flaw here, I'm reluctant to start moving material around.
Yeah, I don't think Lucy's asking for material to be moved around, rather that the last two sentences in the ISB framework, paragraph 4.20, should be added.
Yeah, but John, I think this comes back to, is there a real reason why we need to do this? And I think at the moment, I'm not convinced that there is a reason to do it, because we could do this all over the place. And what we're trying to do is bring in guidance here on principal agent, which is a specific gap. You know, the original debates, you know, took place when they did, and we've been using the framework. And I think unless there is a real problem, we shouldn't try and fix stuff that we don't need to.
Yeah, I mean, I think that is the risk of anything which goes really beyond the rather narrow bounds of the scope, and we came across this yesterday. I mean, to be honest, I think one of the points that Lucy's raised is actually in the second bullet of 5.12. So the only point which is not reflected in the framework at the moment is it following that if one party controls an economic resource, no other party controls that resource. So, yeah, I don't think, I would argue as a staff member that it's not broken. It may be less fulsome, but it's not, I don't think there are any misstatements here.
So I think, I think, Lucy, if you're okay, because we could do this all over the place, and I think we really should not start entering unless there's a problem that has actually emerged in practice. Now, the principal agent thing that I'm not aware has caused a problem. Ross, I don't know whether you're aware of any problems on this that have emerged.
No, I haven't heard any issues on that particular point related to the framework.
So I think, Lucy, if you're okay, I think we will leave that one on one side and move on.
Okay.
Okay.
Okay, so if we can
I mean, it's going to be in the far distant future, but if we do look at the framework more broadly, then I certainly think that the point that Lucy has raised is a pertinent one to look at that point. So noted.
Okay, thanks. So can you move us on to liabilities, please?
Yeah, definitely. Now here, this is agenda item 3.2.7. And in this case, we foreshadowed at the last meeting that we were going to adopt the term a transfer of resources rather than an outflow of resources. So I think that particular question has been settled. The only other change that we're proposing, consistent with that proposed on the asset definition, is that we move to past events plural rather than past events singular. The rationale for that is our experience in standard setting, particularly the work which has gone on transfer expenses and revenue, where it is likely that there will be an initial past event and then a series of future past events which will give rise to a liability. And this minor change acknowledges that. So perhaps I could first of all, through Ian, ask for views on that definition in paragraph 7.
Thanks, John. And just to confirm that the decision to change to transfer resources was a decision at the last meeting. So we're only looking for comments on the move to the plural at this stage. Yeah, Camira, and then Lucy.
Yes, thanks. I agree with the definition. It's just that perhaps it would be useful to include somewhere the definition of transfer of resources. So to make it clear that transfer of resources can also be the execution of specific activities, or perhaps the incurring eligible expenditures or something like that, to make it broader, at least to include a definition to make it clear for preparers on how, what is included there. So thanks.
So on that one, we're trying not to actually give a definition because it's a general term that's in usage in statistics and economics and so on. And so the idea is that you have examples of what could be included in that, but that the definitions actually are at standards level. So, I think very deliberately, the idea is not to have a definition of transfer of resources. John?
Well, we'll come on to this because we have got further guidance on transfer of resources, which currently the framework does not have on an outflow of resources. Personally, I think to be talking about eligible expenditure or specified activities, terms which we've used in standards development, I think that would probably be inappropriate in the framework. I think that's too low level.
So, Camira, can you understand or are you okay with the approach that we're taking?
Yes.
On this, that more detailed definitions would come in the revenue and transfer expenses?
Yes.
Thanks, Camira.
Thanks.
I understand there's a tendency to sort of want to be very, very full in the framework, but I think there can be issues with that. Thank you.
Okay, thanks, John. So, Lucy.
Yes, thank you, Chair. I agree with the definition of liability should refer to past events, but I suggest that we modify the definition to make it more straightforward. I suggest that it should be defined as a liability is a present obligation of the entity to transfer resources as a result of past events. Thank you.
So, John, I think what Lucy is proposing there changes the term transfer. She's
Well, I think
to talk about it as a verb rather than a noun there.
Lucy, I took it that your only change was that we should say a present obligation of the entity for a transfer of resources as a result of past events.
Yeah, exactly. I think this is a more straightforward definition, and it is also aligned with
Yeah.
definition in 4.26 of the IASB conceptual framework.
Yeah.
It doesn't change its, I don't think it changed its meaning, but it's just making it straightforward. Thank you.
So the proposal would be to delete that results and replace by as a result of, sorry, delete that results from, replace with as a result of past events.
If I can restate it, it's a liability is a present obligation of the entity to transfer resources as a result of past events.
Yeah.
Thank you.
Okay.
Mike.
Lucy says that does align more with the ISB's framework.
Thanks, Chair. Can I just clarify then? So we're dropping the reference to a present obligation?
No, it would read, Mike, and Lucy perhaps to come in here, a present obligation of the entity for a transfer of resources as a result of past events.
Okay.
So it's.
Can we check that that doesn't have consequences elsewhere? Because I think the trouble with this, we spent a lot of time developing definitions, and anything that we change has the potential to knock on to other things. So although it seems quite a simple change to make, it may have consequences elsewhere in the drafting and in the interpretation. And I think, again, we need to be really careful not to make changes just for the sake of them. So on this one, John, I think if you can examine that from the point of view of, is it just genuinely tidying up a piece of wording, or is there anything else that would be impacted as a result of that?
Yeah, will do.
We get into drafting like this at our peril on something like the framework. So I think that's an instruction at the moment. And if you can come back and assure us that there are no other knock-ons from that, then I think we could proceed with that. But I stress, we have to be really, really careful not to move things that then have knock-on consequences elsewhere for things that have been used in practice and are working perfectly well.
Noted.
Thanks, Chair. I agree with you. I think, wonder, John, if it's possible to come back to us by Tuesday night so we can resolve it at this meeting.
Yeah, will do.
Okay, so we have a way forward on that. Okay, so I'm not seeing any other flags up. So I'm taking it we're content with that moved plural. So John, then move us on to the next parts of the presentation.
Yeah, we're now into the additional guidance side of things. Okay. The first point is that when we looked at the current framework and looked at what an outflow of resources was described as, and the guidance given on that component of the definition, it became pretty clear that it really gives a very limited steer. At the moment, and note that we have agreed to change an outflow of resources from the entity to a transfer of resources. It simply says a liability must involve an outflow of the resources for the entity for it to be settled an obligation that can be settled without an outflow of resources from the entity is not a liability. So it's really telling you basically that you've got to have funds a flow from the entity. It's not telling you anything about that flow. Now, the IASB framework has a considerable amount of material explaining what a transfer of an economic resource is. Note the fact that we don't use the term economic. And we felt that it would be useful if suitably modified, that material was incorporated in the framework. So paragraph 9 of agenda item 3.2.7 explains what the guidance is that is being added, and the drafting is in paragraphs 5.16a to 16e. Going back to the point that Camira raised, this is fairly high level. It doesn't go into the specificities of items in particular standards. So that allows you to look at those more granular aspects and see whether or not they fit into the guidance, which these 5 paragraphs would provide. So at that point, Ian, perhaps we could go back to the board.
Thanks, John, for the introduction. Okay, so open up for comments on the proposed addition of those 5 paras. Patricia.
Thank you. I have a comment about the paragraph 515(2), because can I say about the 515? It's a present obligation. After that, I have comment about the transfer of resources.
Yeah, because the points connect, Patricia, so go ahead.
Go ahead.
Okay, thank you. In this paragraph 515, I could understand the last sentence. Through fulfillment of an obligation, okay, but because of non-fulfillment of that obligation. I think it is another obligation and not the same obligation. For example, in the case of onerous contract, in the case of penalties, but the past event in relation to main terms of contract is different of obligation related to penalties or other. Yes, because this, I think it's for me, it's not clear. The last sentence in the 515.
Thanks, Patricia. Can we go, are you finished on that point? Because then I'll go back to John just for clarification on that. Did you want to carry on then into the next section?
No, it's only about the,
okay.
Yes, transfer is, it's on my next is about past events.
Okay, so John, if you can just come back on that, because I can see the point that Patricia's making on that.
Yeah, this wording was added as a result of discussions in the revenue project. So basically, we've added the final 8 or 9 words through fulfillment of an obligation or because of non-fulfillment of that obligation. I think that Patricia's point is that if it's non-fulfillment, then a new obligation arises. Is that right, Patricia?
I mean,
yes, but maybe it is only established in the revenue statement, not here. I think it's not the general principle in the conceptual framework. And I in my view, it's necessary to discuss more about the kind of obligation related to the binder arrangements in the inception and after the inception too. But my view, it's not necessarily the last sentence here.
The whole sentence, or would you just end it?
So, John, can we not do editorial in the meeting?
Okay, all right.
What I would like to ask staff is to take that away and to refine the drafting, because I certainly accept Patricia's point. It's not clear as it's currently expressed. And what we need to do is make sure that it is clarified in accordance with the decisions in the revenue project, so that it genuinely does explain things in that respect.
Okay.
Okay.
Yeah.
Thanks. So, Patricia, did you have another point, or is that cleared your point? If we take it offline in that way, that will address your point on 515.
Okay, thank you.
Okay, thanks for that. So go to Mike, and then Camira, and then Lindy.
Thank you, Chair, and thanks, John. So Chair, I'm happy with what's been added to 516. 516 makes it very clear that we have a liability, and it must involve a transfer of resources. 516A, the way it's written, because it talks about the potential, it may be uncertain, it's not even likely. It reads more like a contingent liability to me than a liability. So I don't know if that was the intention, John, but I thought 516A was just confusing me because it's not discussing a liability at all.
Well, I think the point is that under the framework, it's questionable whether such a thing as a contingent liability exists. Now, we've not actually really developed that at a standards level. But what it is saying is that, you know, a liability may be dependent on one or more specified uncertain future events. So I think this is an example of tension between the standards level and the concepts. And that tension really, I think, also applies to the ISB's framework from which this material has been drawn.
So, John, just to clarify, you've said framework drawn from the ISB's framework, paragraph 4.37 with minor amendments. So that's just purely terminology, is it?
Yeah, I think that's right. You know, for example, the ISB used the term criterion for a liability, which we've not used. So instead of to satisfy this criterion, use the term to satisfy the definition of a liability. But in substance, it is the same, exactly.
So Mike, on that one, I think John's right to point up that tension that we have between the framework and the standard, which is the same for ISB as it is for us. So what I propose on that is, can you take that away and just check whether there is anything that causes you a problem because of the way that John has updated the drafting for our framework, as opposed to something that's already in the ISB literature.
Yeah. And that paragraph, Mike, is 4.37 in the ISB framework.
Okay, so thanks for that. So Mike, if you let us know if you still have a problem when you check that. Camira is next, and then Lindy.
Yes, thanks. My comment is also related to Mike's observation. So I support what is written in that paragraph 5.16a, because if we analyze it in the context of also of the revenue project, this paragraph would also allow what we were discussing in revenue, that the recognition of revenue, it doesn't, or the recognition of the liability, it doesn't depend, it's only about the capability to enforce the fulfillment of the present obligation, and not necessarily the probability that enforcement will occur. So that this paragraph would help the revenue project in that sense. But after reading it, also says, well, does that mean that it will be a contingent liability in the case of, so that's, I think that will be good to clarify somehow. But I think the paragraph is really useful. So thanks.
Thanks, Camira. So I think, you know, on that one, that may be the solution to that, may be that we address that at standards level. If the drafting genuinely does come from the ISB's framework, at this stage, we probably shouldn't try and change the sense of it just simply because there is an ongoing debate about probability threshold or not probability threshold and so on. So it's one of these things where there is a rather uneasy truce at the moment, if I can describe it in that way. John?
I think, Ian, this also crosses into 5.16b as well. So it's a more general issue, yeah.
But I think if it's an issue that is present in both the ISB framework and ours, you know, that's an unresolved debate at the moment, and actually we shouldn't change it in our framework in a way that might then cause a problem with IPSAS 19, for example, or it might cause a, you know, we can be more specific, Camira, to remove the option in the revenue guidance, I think, and that's probably the right place to do it rather than in the framework. So if we're okay with that, but then Camira, if you can have a look, keep a watch on that one, and then when we get to the appropriate point in the revenue project, have a look at it there. Okay, so if I can go to Lindy.
Thank you. Maybe some of the challenges, the IASB's framework just talks about obligation, and we've said present obligations. You might just want to look at, and that might cause some confusion when you read it. My comment was, sorry, and taking us back to 515, and conscious of what we've discussed. I was wondering, you know, one of the challenges we had was on the outflow, but also on the little or no realistic. And the IASB talks about practical ability, no practical ability to avoid. And I do wonder if we're taking the text on the transfer, I think they might have been referring to that notion and not little or no realistic alternatives. So I don't know if that's a consequence of bringing transfer in, and maybe we could look at that. And I think that, you know, the last part on obligations, I don't know, could actually come out of the framework because it comes into the revenue side when you relook at the wording in 515.
Okay.
I wonder if we should just make it quite short and just talk about no practical ability to avoid and do the rest, and the rest comes in the standards level around.
Yeah.
Sorry, that was a lot, sorry.
If I could just respond to that, I mean, I think this brings into play some of the issues that the chair raised when we were talking previously about both assets and liabilities. Yes, the ISB does use the phrase, an entity has the practical ability to avoid transferring an economic resource, whereas we've got this rather more legalistic, no realistic alternative to avoid. I mean, I felt that it was just pushing the scope of the project a little bit too far to start making changes of that nature. And it also goes back to the unforeseen consequences point that Ian previously raised. So certainly to acknowledge Lindy's point, that the ISB does use this formulation, no practical ability to avoid.
So in terms of that, I think, John, you know, the action around the transfer, the terminology, you know, the text that's been brought in 516A and so on is just to double check on that there's no changes of substance that have been introduced. So it's to look back against the ISB wording and to see whether there's any change of substance. It's just a change in terminology. And that was essentially the approach to Mike's point. On 515, I think, unless there is a reason to change because it brings in a conflict, I would suggest we don't on that.
Yeah. No.
Lucy.
Yeah, thank you, Chair. My concern actually is on the last sentence on paragraph 5.18 about legal and non-legally binding obligations says that, however, it is not essential to know the identity of the external party before the time of settlement in order for a present obligation and a liability to exist. I think for public sector perspective on accountability and transparency, this sentence appears not tolerated or allowed because an entity is required to ensure that all its creditors' identity are verifiable and are disclosed in SLs or in aging schedules, or in some cases even in notes to financial statements, particularly if the amount of obligation is material. In our jurisdiction and perhaps to a number of jurisdictions, no appropriations or public funds can be committed or used to pay obligations for undisclosed payees. Otherwise, they may be construed as ghost creditors and are therefore considered as invalid obligations, or the so-called blind certifications to accounts payable. The identity of external parties or creditors is also important to facilitate the audit procedure on confirmation of the existence of valid obligations that form part of the payable account balances. So I suggest, therefore, that we delete this sentence so it cannot be misinterpreted that we allow non-disclosure of the identification of an external party to which the entity is indebted. Thank you.
Thanks, Lucy. John, back on that.
Well, certainly, I think Lucy's given some good reasons in terms of general financial management, why you'd need to know the identity of the external party. But this is just a straightforward guidance that, you cannot argue that you've not got a liability just because you cannot specifically identify the parties. So I think it's a slightly different point. We're not advocating a particular model of financial management. We're just saying that an indication not being able to identify specific external parties doesn't necessarily mean that you haven't got a liability. And then there are plenty of examples of that in the social benefits areas.
Yeah, I think that's actually the very specific area that, it's not individuals, it's that we know there would be a year-end liability on a social benefits scheme. So I think, the point you make is valid, Lucy, on specific purchases and so on, but for a generic scheme, actually it's intended to cover that. So I think that's the reason why we should leave that.
And if I could also add, Chair, for those of you who do have the ISB framework in front of them, this is consistent with the last sentence of paragraph 4.2.9. It is not necessary to know the identity of the party or parties to whom the obligation is owed. So I don't think that there's any public sector reason to depart from substantively what is in the ISB's framework.
Can we have an additional guidance just so that we could specify that, like for instance, what you said, that it for social benefits doesn't have to be necessary that we know the identity of the external parties, but in other areas there is really a need. There is really a need to identify the identity of external parties, just so that this cannot be misinterpreted that we are allowing such without qualification. Thank you.
Ross, back on that.
Mm.
Yeah, I think I see your point, Lucy, but I'm a little concerned as this is original drafting from the framework already. It's consistent with the ISB, and this is the framework. It's not where the guidance actually goes. So people shouldn't be using this to decide whether they're recognizing liabilities or not. They should be looking at the relevant standards where that specific guidance should be added.
Yeah.
So I really think we should be focused on the issues at hand and not adding things to the framework. Again, we have a standard on social benefits. If people want to understand how to recognize liabilities there, they should be looking at that standard, not the framework itself. So I would leave it alone.
Okay, thanks for that, Ross. So I think we leave that. So taking us back then to that initial, the inclusion of those paras 516A through 516E. Any further comments on those? Okay, so John, take us back then to the slide in terms of walking through the recommendations.
Yeah. Okay, the next additional paragraph is new paragraph 5.17a in agenda item 3.2.2. And this makes the point that the transfer of resources resulting from the past event must be incremental. And I think this responds to an issue which was raised in the revenue project. And it's explained, if I could just go back. Sorry, one moment. Yeah, it's explained in paragraphs 11 to 14 of agenda item 3.2.7. And this is again drawn from paragraph 4.43 of the ISB framework. The only change being that we have modified the phrase taking of an action so that it is specific to non-legally binding obligations.
Okay.
Perhaps I could ask for views on that. We've also, I should add, deleted a deal of the drafting in current paragraph 5.17 because we felt that that was already adequately described further in that chapter in paragraphs 5.24 and 5.25. Okay. So a key point that in order to meet the definition of a liability, the past event must give rise to an incremental sacrifice of resources. Okay.
Thanks, John. So take comments on that proposed change. Mike.
Thank you, Chair. So I'm on 517A.
Yeah.
I've got a quick typo and a question. So I think 517AB should start with the entity has taken an action rather than just taken an action. But my question is, just clarify why it's got to be non-legally. Why don't we just say creates a binding obligation? I know you mentioned that and it's come straight from the ISB framework, but I couldn't understand why it had to be non-legally.
Well, I think the view was that if an entity's taken an action, then that would result in a non-legally binding obligation because it would be unilateral. So that's the rationale.
Okay.
We're linked taking an action to a non-legally binding obligation rather than more generally to binding obligations.
Thank you.
Okay, thanks, John. And we note that bit of drafting, Mike, so thanks for that. So next I've got Patricia and then Lindy.
Thank you. My point is the same of Mike. And because I think the entity can take an action related to legally binding too. It's not only non-legally. For example, if the entity decides not to fulfill the obligation in the contract, the entity assume the obligation related to penalties, for example, and not obtain, in this case, economic benefits or service potential. My suggestion here is, my suggestion is to delete the non-legally or include legally.
Right.
Thanks, Patricia. John, back on that.
I mean, personally, I'd be, and I think probably, Ian, we need to discuss this offline before coming back to the board. I mean, I would prefer to just talk about a binding obligation. Because I think, as written, and both Mike and Patricia have challenged this, it leads to the possibility that, you know, individuals will identify cases where an entity can take an action that creates a binding obligation that is a legally binding obligation. Now, I can't think of any offhand, and I think that the reason for drafting it like this was because of the discussion which had been had in the revenue project. But I question whether we need to be so specific.
So, John, on that, I think provisionally we should say we would move to propose moving to a binding obligation. But I think, consistent with the approach that we've taken on that other point that Mike raised, I think I would ask you just to clarify whether, and for any board members who see a problem with that, just to contact you, and then we can resolve that one for Tuesday.
Yeah.
I don't want to leave that hanging after this meeting, so you can just resolve it in that way. Okay, Lindy.
Can we just clarify what we're asking members to do, Ian? Sorry for my purposes.
So basically, the provisional decision is that we move to a binding obligation, but that's subject to confirmation that making that change to include legally binding obligations doesn't cause a problem. So I just want, you know, members who have a view on that to contact John in the next day or so that we can resolve it for Tuesday. So actually, if we say, if you can contact John if you have a view on that immediately after the session today, and then that will allow John to formulate views and come back. But provisionally, we agreed to make that change because it's been brought up by 2 board members.
And just to note what I think is stated in the paper, that the parent paragraph in the ISB framework is 4.43.
Okay, thanks. Can we go to Lindy, please?
Yeah, and I suppose this is something now I must email to John, but I think if you look at 523 in the discussion on the attributes for non-legally binding obligations, it seems there's a bit of a tension between what we've included in 17A(b) and what's in those paragraphs. So I just have to check that.
Yeah.
So Lindy, if you can work with John to resolve that, because I do want to resolve it at this meeting. I don't want to leave it hanging. Okay.
You're suggesting that the tension is caused by the inclusion of non-legally binding in 5.17A.
Yeah, I mean, the subsequent section actually does clarify when you have legal and non-legal obligations, and we've kind of include 17A here, and we're quite definitive, and then we have further discussions. I don't know, and I just wonder, we just have to check that we're not saying something different.
Yeah.
Which I think are in SIP 523. And if we need 17A, but yeah.
Yeah, noted.
Okay, thanks for that, Lindy. So if you can you can work with John on that, that's good. Okay, so take us on to the final point then, John.
Yeah, the final point is that at the June meeting, staff were instructed to look at the implications of adopting the term transfer, as in transfer of resources, at the standards level. Now, we've done that and we've discussed it with Eileen and other colleagues, Paul and other colleagues who are involved in the revenue project. And we've come to a view that any potential confusion could be mitigated by adopting the term transfer revenue in the IPSAS being developed from ED 71 rather than the term transfer. Okay. So to summarize, we don't think that there's any major tension between the way that the term transfer of resources is used conceptually as proposed and the standards level, but we do think that the board ought to consider whether the term transfer in development of the final standard on standards on revenue and transfer expenses should be changed to transfer revenue. And this is discussed in paragraphs 15 to 17 of the paper. So through the chair, perhaps I could ask the board to, consider that discussion.
Thanks, John. Okay. Lynn.
So I can understand what John's saying, and I can support this if required, but I wondered if we ought to keep in mind when we're doing the revenue project, if there could be a better term for this transfer revenue in due course, to avoid any confusion, because here we are in a liability chapter talking about transfer of resources. If there was a better term for the revenue side, I would be in support of it. So I wouldn't want to lose the opportunity to reconsider that as we get towards the end of the revenue project, whether or not that still works as a term, or if there's a better term that wouldn't use the word transfer.
So Lynn, can I just check? So you're content that we use a more specific?
I won't stand in the way if everybody thinks we should use transfer revenue. I would just encourage us to, if we get to the end of the revenue project and there was a better term, I'd be in favour of it.
Okay, so if you'd be okay if we provisionally decided that we should use the more specific term at the standards level, and at the moment, let's transfer revenue, obviously, and then see whether there is any better term that emerges. Is that reasonable? Yeah. Okay.
Yeah.
Good. Okay. Well, I think that gives us that's helpful. That gives us the way forward at the revenue level. So, there's sort of a square bracket around that specific term, but we can work on that for the revenue project.
Yeah.
Okay. Good. So, John, I think that gets us to the end of the liability item. Is that right?
Yeah, that does, and that is the final substantive item in this session.
Okay, that's good. So we've got a couple of items there that we'll bring back just to confirm on the Tuesday that no change is required. And then we will see this item back in the October check-in in terms of specifics around unit of account, the executory contract interplay, and also the points about item versus rights.
Yeah.
Good. Okay, so I think with that, we come to the end of the conceptual framework item. So I think we will take a break at that stage. So I suggest, having made it through that, I suggest we break for 15 minutes, come back at 25 past.
Yeah, and just thanks to everybody from me, and thanks particularly to Jo for her help, and to other colleagues for the discussions on standards level developments with an impact on the framework. So thank you.
Okay, good. So back everyone at 25 past. Thank you.
Yeah.
1 minute.
Excellent. So thanks, everyone. I think most people are now back. Obviously, I think what emerged from the conceptual framework update is the degree of interrelationship that's emerged between that work and the revenue and transfer expenses project. So now it's natural that we move on and look at the issues, if you like, at standards level. And again, responding to board member feedback, we've allowed plenty of time for the in-principle debates that we're going to have on revenue in order to make sure we, we can get to the right decisions that will take us forward on both these projects. So with that, I think pass over to Eileen to take us into the first item.
Thank you, Chair. Okay, so hello everyone. Thanks again for your time and input onto the revenue and the transfer expense projects. We will be presenting both projects in one agenda item this time. And as you'll note, there are 6 papers, but we plan to break this out into 4 different sections throughout today and tomorrow, just to help focus us on the different aspects within the 2 projects and make sure that we're able to have consistency in principle where it is necessary to do so between the 2 projects. Now, today, we are going to start off with the existence and recognition of a liability or an asset, and the liability is obviously from the revenue perspective and the asset from the transfer expense perspective. And we thought that would be really helpful just following John's section immediately, as we have just spoken about the definition of a liability and the definition of an asset. Now, the liability paper, which will be the first focus before we move on to asset, really builds on what the board has started to discuss and also the decisions that the board has already made within the last 3 sessions. So in March, the board had first started to talk about liability in the context of a binding arrangement and had reached the preliminary conclusion that enforceability of a binding arrangement gives rise to a liability, i.e. deferred revenue, to the extent that the arrangement is not yet satisfied. However, at that point in time, the board noted that it would be useful to clarify what constitutes an outflow of resources and to understand how that is eventually extinguished. Now, the outflow of resources, as John noted earlier today, was first discussed in June and has now been fully wrapped up, if you will, with the change to transfer of resources, and we're looking to more so clarify what transfer of resources means. But 2 of the key components that came out of those discussions in June, as well as in September, will also be feeding into the liability discussion today. Now, today we are hoping to wrap up the discussion on the accounting principles associated with the recognition and derecognition of a liability for the transfer recipient. Now, following that, we will be discussing the asset paper, which Paul will be presenting. And in contrast, this is the first time we'll be discussing the existence and the recognition of an asset for the transfer provider in its transfer expense transaction, based on the comments received from ED72 respondents. Now, since the board will be discussing this for the first time, we will be presenting a bit more introduction and analysis in the presentation today before opening up for member discussion, just so that we can be a bit more comprehensive with the discussion itself. So the first slide here is going to be on the liability paper. Now, as a gentle reminder for members, the revenue transactions can come from transactions without binding arrangements and transactions with binding arrangements. This paper is in the context of revenue transactions with binding arrangements, and therefore enforceability is a really important component here. Now, the board has made several useful decisions over the last 2-3 sessions about binding arrangements, about the enforceability of these binding arrangements, and also the definition of a liability, which are summarized in the paper in paragraphs 7 and 8, and also detailed in the appendix. What we thought might help today in facilitating the discussion with the board is to just go through the 2 scenarios that we have presented in the paper to flow through where and what situations a liability would exist, and therefore the transfer recipient, which is the entity applying the revenue standard, would need to recognize the liability, and we'll eventually talk about the derecognition of the liability. Now, as we noted in the earlier session from John, the definition of a liability has 3 components. The first is that the entity, in our case, we're going to be talking about the transfer recipient, has a present obligation. The second component is that past events have occurred. And the third is that the transfer of resources are now required as a result of the identified past events. Now, the one thing we wanted to note for the transfer of resources here is that some of the clarification guidance that has now been proposed for the framework include the fact that the transfer would be to another party, and also that it would be incremental. And we thought it'd be useful to clarify here that in the context of this revenue discussion, other party could actually just mean the transfer provider. The essence of other party is really that it's leaving your entity, so it's leaving the transfer recipient. And in most cases, it could be, say, the right of return, where you are returning the resources to the transfer provider. So we just wanted to clarify that point before moving into the scenarios. Now, with scenario 1, it's clear that the first component of the liability definition would be met, because as we have currently defined binding arrangement in our proposed IPSAS, a binding arrangement will always have at least one present obligation for each entity. Past events have also occurred because the transfer recipient has willingly entered into the binding arrangement. And in scenario 1, where the transfer provider fulfills its obligation first, another past event has occurred, which means that the transfer recipient has actually received resources from the transfer provider before the recipient itself has actually fulfilled any obligations. This means that the third component is really the final piece that we have to consider whether we have or have not met to meet the definition of a liability. And in staff's analysis, we noted that there may be circumstances where there is a transfer of resources now required for the transfer recipient as a result of these identified past events. However, there are certain criteria that need to be met, and we'll go over that in the next slide. So the current conclusion for scenario 1 is yes, if specific criteria met. Now, if we look at scenario 2, where the transfer recipient fulfills its obligation first, same for the first 2 components, there is going to be a present obligation for the same reasons previously identified. And there are past events that have occurred, willingly entering into the binding arrangement. And in this scenario, it's the fact that the recipient has actually fulfilled its obligation before receiving any resources from the transfer provider. However, component C of the definition of a liability would not be met because there are no further transfers of resources or consequences that are left for the transfer recipient in this type of scenario. So in this case, the definition of liability would not be met. So if we consider the analysis and what it really means in terms of the, apologies, there might be some sneezing in the background. The analysis indicates that a present obligation may give rise to a liability or deferred revenue in a binding arrangement if certain circumstances are prevalent, i.e. specific criteria are met. Staff conclude that an entity recognizes a liability, i.e. deferred revenue, when both of these following criteria are met. The first is that the transfer recipient receives resources associated with its unfulfilled or partially unfulfilled obligation in a binding arrangement, and as a result, the transfer recipient has not actually yet earned any revenue. And the second criteria is that if it does not fulfill its obligations associated with the resources it has now received, it is required to transfer resources to another party, which is therefore an incremental transfer to another party. And this is directly associated with the consequences of non-completion. So if we really take a step back and think about what really poses this liability, actually really is rooted in the fact that binding arrangements are enforceable, and the enforceability of these binding arrangements are holding the entities accountable to completing their obligations for any resources, i.e. rights that have already been satisfied for the transfer recipient itself. So I'll take a pause here just to have the member discussion on this first recommendation before we go back to the derecognition piece to discuss the, if you will, the subsequent accounting after you have recognized the liability.
So thanks for that introduction, Eileen. So open up for member comments in terms of agreement or otherwise, or just questions in terms of what you presented. Yeah, Camira.
Thanks, Chair. Thanks, Eileen. I have only one suggestion, is to define that it's present obligation rather than only obligation, just to be consistent with because we have been used already to the term present obligation, and in those paragraphs it's just written as an obligation. And only I have another question, but only for my understanding purposes, and also because some focal members were asking about it. What I was not present in the very origin of this project, the revenue project, so those countries wanted to know what was the reason of the IPSASB to depart from the definitions of stipulations, conditions, and restrictions. So just as for my own knowledge and to be able to clarify that when the question comes. Thanks.
Thanks. So, Camira, if I pick up the background point, I mean, I think the problem was that people were finding it problematic implementing the stipulations, conditions, and restrictions typology in practice. It left a lot of kind of grey areas, and so therefore the view of the board was that in taking the opportunity of bringing in the new thinking in IFRS 15, that we should also reopen that area as well. You know, the people were finding the other part of IPSAS 23 in terms of the taxes side worked reasonably well in practice, but it was that side on the transfers, what we call transfers in IPSAS 23, that was causing people problems. So that was really what we were trying to do, was trying to address those and to arrive at a more something that people could apply more consistently and perhaps less judgmentally in certain areas. If that makes sense. Eileen, do you want to pick up the first part of Camira's question?
Yeah, happy to. And thanks for the comment, Camira. That definitely is something that we've got considered in terms of putting the actual draft IPSAS together. I guess the one thing we wanted to highlight for members is that the exact wording in the recommendation is not necessarily going to get taken in directly into the IPSAS. We'll definitely be making sure to use the right terminology and working with you know, various members to make sure that we get the wording right to properly capture the principles in the authoritative guidance. And then in the application guidance, the non-authoritative guidance will include any additional clarifications as necessary to make sure that, you know, any thinking in these papers, in our discussions that will help constituents later on will also appear there. But we'll definitely make sure to keep that in mind to make sure we don't cause any confusion between obligation and present obligation.
Okay, thanks for that clarification, Eileen. So I've got Ajith, Chris, Todd, Lindy, Renee, and Mike in that order. So go to Ajith first.
Thanks, Ian. Yeah, I was looking at this recommendation in light of an example. For example, if we take a situation where the government gives a grant to build a hospital, and on the reporting date, the hospital has not been built, but the entity intends to build the hospital in the next year, the following year. And there is a binding arrangement, and under the binding arrangement, if the hospital is not built, there may be a necessity for them to return the money or have some other liability in relation to that. So in that situation, now according to this wording that is given there, it appears that there is a liability because the money has been received and the entity has not built the hospital as yet. But when I look at the conceptual framework as newly drafted, in 5.14, the conceptual framework says present obligation of the entity for a tranche of resources results from past events. Then in 5.16, it says a liability must involve a tranche of resources from the entity for it to be settled. An obligation that can be settled without a tranche of resources from the entity is not a liability. So that's what 5.16 says. Specifically says an obligation that can be settled without a tranche of resources from the entity is not a liability. So now, based on the conceptual framework, we need to consider whether the obligation can be settled without a tranche of resources from the entity. Now, in this situation, I feel that there is a possibility for that entity to avoid the transfer of resources, that it can be settled without a transfer of resources because it can build a hospital. Building of the hospital itself, I don't think is a transfer of resources, because building of hospital is an exchange of resources. You give money and you give the builder, and the builder builds money, builds the hospital, or you might build the hospital yourself. In either case, it's an exchange of resources and not a transfer of resources. So I feel that in this situation, it is the obligation can be settled without a transfer of resources from the entity, and therefore it is not a liability. So I feel that in an example like this, under the conceptual framework, it is not a liability, but as defined here, it is a liability. So that's my comment. Thank you.
Thanks, Ajith. Eileen, want to pick up on that?
Yeah, happy to. Thanks, Ian. And thanks for the thorough example there, Ajith. I think my first reaction would be that it's important for us to differentiate the present obligation from the liability itself, because the present obligation is a component of the definition of liability, and you really do need these other considerations to be present for the liability to exist. And so when I think about the example you've listed, I do agree, if you build the hospital, you don't have to necessarily transfer resources out in the act of fulfilling your present obligation. But as you build the hospital, you're actually lowering the liability that you have, because there's less of the resources you've received from the government that you now have to, for example, repay to the government if you do not build the hospital. And so they are absolutely connected, but I wouldn't say that they are one and the same. And so as you are building the hospital, it's actually a way for you to measure the derecognition of your liability, and therefore the less really like the less amount of transfer of resources to another party that you would actually have remaining to recognize on your financial statements. So the present obligations can lead to the liability, but the liability itself is not fully defined by what you do in the present obligation itself. I hope that clarifies and that I've captured your point properly, but let me know if there's anything I can clarify further.
Yeah, I have a concern on that, because what I'm considering is the date of the balance sheet. Now, if on the date of the balance sheet, you have already received the funds and you have not built the hospital, but you're planning to build the hospital in the following year, then now you have not fulfilled the obligation. You have not fulfilled the obligation, but you're going to fulfill the obligation the following year. So an obligation can be settled without a transfer of resources from the entity, because the entity can build the hospital. building of the hospital itself is not a transfer of resources, it is an exchange of resources. You're giving money and you're getting the hospital. So it's not a transfer of resources, it is an exchange of resources. So my view is that an exchange of resources is not a transfer of resources. Because if you consider the exchange of resources as a transfer of resources, then you have to recognize the asset as well. Because it's an exchange that you're getting, you're having. So because it's an exchange you're going to do, if you're recognizing the liability, then you have to recognize the asset in relation to the exchange. For instance, if you're going to build a hospital, then when you pay the money, you get the hospital as well. So you have an asset and a liability. So it is not I don't think it's a transfer of resources as explained in 5.16 of the conceptual framework, because the conceptual framework says an obligation can be settled, and that can be settled without a transfer of resources from the entity is not a liability. So based on the conceptual framework, 5.16, I feel that on the date of the balance sheet, you need not recognize the liability because that liability, that obligation can be settled after the balance sheet without a transfer of resources.
So Eileen, have you got anything to add to your previous explanation? Because I felt personally you'd actually addressed the points that Ajith had raised. I don't know if you've got anything else to add. It clearly is something that needs to be worked through, but it sounds like this is just a misunderstanding or a difference of understanding as to what transfer and exchange actually mean. So Eileen, unless you've got anything else to add, I would suggest that we take this example offline and we work through the new drafting and identify precisely within the drafting what is causing Ajith concern.
Yeah, I'm happy to connect with you offline, just to make sure we fully understand your concern, especially with this example that you proposed. I guess the only other thing I'd add now in our wider call with the other members is I think when you think about the reporting year itself as well, I think you still need to look at whether or not you have or have not fulfilled your present obligation in the binding arrangement at your reporting date. And so even if you do have a plan to build the hospital, you technically haven't yet built the hospital, and therefore that does still mean that you still have this outstanding present obligation that is not yet fulfilled. But Ajith, I can definitely connect with you offline and make sure that we address your concerns, and also connect with John in case there's any wording that we have in the conceptual framework and what we will eventually put in the revenue standard to make sure that there are no inconsistencies or miscommunications to make sure we get it right.
I mean, I think the capital grants example is a good one in terms of testing the definition, because it's clearly a more complex and more contentious end. So actually, I think that would be a helpful exercise to do in testing the new wording in the conceptual framework. Okay, so with that, we move on. Then I've got Chris, then Todd, then Lindy.
Thank you, Chair. I'm just trying to place myself in the position of a preparer. So I'm wondering at what instance does a transfer recipient first fulfill an obligation? Because it doesn't, I don't seem to see it. How would I mean, what is a practical, maybe we may give a practical example of when or how a transfer recipient fulfills an obligation first before the transfer provider. So I'm having some confusion there.
Chris, Eileen?
Yep, thanks, Chris. And thanks for pointing that out. I know the example that we have in, I think, Appendix 2 of the paper is really only from the scenario 1 perspective, when the transfer provider first gives resources to the transfer recipient. Now, I think if we try to tailor that even for the scenario 2 that you're hoping to see, I think an example would be the transfer recipient starts acquiring and giving the vaccine to their hospital staff, similar to that example, but they haven't actually received any money yet. So they would be more likely to have, say, a receivable where they can then go to the transfer provider with proof that they have fulfilled these present obligations of acquiring and administering the vaccines, so that they have the claim to the resources that the transfer provider has not yet given. So I think that example, if it is something that members find would be useful for constituents moving forward, we could definitely tailor that in some way to either bring in on its own for the liability side, or also to give a bit more color for scenario 2. But that would be an example of when the recipient is the first to fulfill its obligations.
Yeah.
Okay, thanks for that, Eileen. So then go to Todd, then Lindy, then Renee.
Yeah, thanks, Ian. When I read through the recommendation, I sort of paused a bit at the second part around if the transfer recipient doesn't fulfill its obligations, that particular clause there. And I think when I read that, it came across to me as though, you know, we're talking about binding arrangements needing to have some sort of right of return written into them. And I certainly reacted to that when I read it, but it was very helpful engaging with staff, because I don't think that's sort of what they had meant to convey there. And I think for me, there are some things that are important that we're clear on when it comes to the recognition of a liability. And I think we established that through previous meetings, that it has to be a arrangement, which means it has to be enforceable. Now, enforceability, first and foremost, should be about actually being able to compel the recipient to fulfill the contract, and right of return may be one of those things that happen. They don't fulfill their obligations, but penalties may be other. You know, there will be some transfer of resources outside of the entity if they don't fulfill the obligation. So I can get to there. But I think it's quite important for me, and it's something that I've raised before, that to be an enforceable binding arrangement, there needs to be a level of definition in the binding arrangement so that both parties have a reasonably common understanding as to what's to be delivered under the binding arrangement. And so from a transfer recipient's perspective, it needs to be reasonably well defined what is required to be delivered. And if that isn't particularly well defined, then I'm not sure on what basis a transfer recipient would be able to recognise revenue. So there needs to be some reasonably well defined obligations so that they have some idea of how they can recognise revenue under the arrangement. Also, there needs to be that level of definition or specificity in the binding arrangement from the resource or from the transfer provider's perspective as well, because if there isn't, then I'm not sure how they would be able to enforce. So that's quite important to me in terms of being able to enforce the arrangement. And just wanted to make sure that that was a common understanding across the board in terms of moving forward with this recommendation.
Thanks, Todd. I mean, clearly, you know, drafting is going to be very important in terms of enforceability, but equally, we are going to have to strike a balance because, you know, of differences between jurisdictions as well as between agreements in terms of what the mechanisms will be. So I think that's going to be the tricky thing. Eileen, do you want to just sort of indicate the way forward on that one?
Yeah, absolutely. And thanks, Todd, for bringing it to the board's attention too, because I think you and I had a discussion to make sure we're on the same page. I think it's important that the members as well. What it really meant for me is as Ian said, drafting is really, really key to make sure that, we've had a lot of great discussions on enforceability, and, binding arrangements are by definition enforceable. So we really need to communicate what that actually means. And as Todd highlighted, if we really want to put in layman terms, it's what are you enforcing and how are you enforcing it? So I think, we'll continue to work on that with the wider group to make sure we get the wording right so that we capture the principles of enforceability appropriately. But thanks for the intervention.
Yeah, thanks. That was somehow quite useful to hold in mind. So go to Lindy and then Renee and Mike.
Thanks, and I support what Todd said, and I think it is important the devil is in the detail and how we write this. The one comment or question I had was, we start this with, you've received the resources, and I was wondering if there could be a scenario where the transfer recipient is due the transfer but hasn't yet received it because, as you know, it was due on a certain date and the date passed and the transfer provider hasn't performed in terms of that. So would there be a scenario where it's not just you've received the resources but you have a right to the resources and then possibly have the obligation, or is that something outside of this? Thanks.
Would you like me to respond to that first? Yeah. Okay, thanks, Lindy. I was thinking about that as well, and you might have seen a similar situation in the asset paper that we'll be presenting next. And I guess the way I see that scenario is that it's actually still wholly unperformed or unfulfilled by both parties, because you do have the right in the binding arrangement that you signed, and so you are due the resources, but because you haven't received it yet, then there wouldn't technically be any accounting yet. So as Paul had mentioned during our discussions in April, you would have an intertwined asset and liability that would actually net to zero. So there wouldn't be any accounting, if you will, until you actually receive the resources from the transfer provider, and therefore your right as a transfer recipient has actually been fulfilled at that time.
Okay, Lindy. Linda, you're okay on that one?
Yeah, I'll think about it. Sorry, the connection was a bit sketchy, but I'll raise it if I'm still stuck there.
Okay, thanks for that. So go to Renee and then Mike and then Mark and Patricia.
Yes, thank you, Chair. There was one point I wanted to make, and then a follow-up on the conversation, one of the earlier conversation with Ajit. My first point is I wanted to raise pretty much the exact same point that Todd raised about that second criteria. And I will just build on what Todd said. What I wanted to put forward to the board is, and you already acknowledged that the difficulty will be in the drafting, or the importance will be in the drafting, but the reaction I had is that criteria is introduced as a criteria, but it seems to be redundant with what is the nature of a binding arrangement. Already in a binding arrangement, by definition, it implies that it's enforceable, and through enforceability means that there will be something happening, either a transfer of resource, or if the transfer of resource doesn't occur, some other means. And therefore, is it a criteria, or is it just additional guidance in how you interpret the implication of the transaction and the implication of the elements of a binding arrangement? So basically, yes, you need to have received the funds. The first criteria makes a whole lot of sense. There's no deferred revenue or liability if the recipient hasn't received the transferred funds. But then maybe it would be a lot more simpler and maybe more principles based to say, and then you have to assess whether the definition of a liability is met. And then in doing that, we create the guidance, and we frame it as guidance, as additional guidance. And back to Todd's point, specificity, right, is going to be part of the considerations in assessing the liability. So that was the point I wanted to add, in addition to Todd, to build on. To me, the criteria, adding a criteria, a strict criteria, the way you're framing it. In substance, I agree with it, but I don't think it's a criteria. It feels like it's redundant, and so I'll leave that with you. The point I wanted to make to follow up on the conversation you had with Ajit.
Would it be just appropriate for Eileen to respond back on that, and then we'll come back to you?
Thanks, Ian, and thanks, Renee. I absolutely take your point, and my thinking going towards the drafting we will put into the IPSAS after we get the board decision on this item wasn't necessarily to include the criteria as they are listed now. The way we presented in the paper was more intended for us to just think through, like, really in what cases will we actually have a liability for the transfer recipient. And so apologies if it's come off as if that's the actual principle we would be putting into the IPSAS, but I absolutely take your point. It's more about, really elaborating further, because we have already, established really good principles on enforceability, and that's been a really key, stake in the ground, if you will, to lead us to this discussion now. So I definitely take your point. I just hope that provides a bit of comfort that we're not going to just copy paste this recommendation in as the principle itself.
Okay, thank you.
Yeah.
Okay, that makes sense.
Go ahead on the actual question, Renee.
The second one, yes. Yes, so thank you. Let me collect my thoughts. So basically, in the exchange with Ajit, there was a point made that a transfer of resource or the exchange of resource may not necessarily, yes, an exchange of resource. So in the example that you're building an hospital, I think Ajit sees the cost incurred to build the hospital as an exchange of resource because you're getting back the actual hospital. But to me, I think that scenario would still meet, would still be in the nature of transfer of resources, because we are talking about the resource received here is the grant to build a hospital. So there are different ways that grant can be transferred out to a third party. So that's my understanding, and I'm testing it with you, Eileen. You can transfer it by paying suppliers to the construction cost for constructing the hospital. So you've transferred the resources outside your organization as a recipient. Or if somehow you've incurred, you could incur penalty, again, you would transfer. So there are different scenarios for transfers, but I thought building a hospital was an acceptable scenario for transfer of resources. So I just wanted to clarify that. Ajit's intervention was really good, I think, because maybe we need to clarify that in the guidance, as long as I'm right. And I want to test that my understanding is correct.
Talking actually. So Eileen.
Yeah, thanks, Renee. And I think it definitely is a good example for us to discuss as a group, just to make sure we are testing the principles we're outlining here. And I think in the example that you've listed where, you are still transferring some of these really grant funds that you're receiving to third parties because you have contractors, you're buying building materials, whatever it may be. I think in that case, it is quite clear that it would meet the definition of a transfer of resources, because it is leaving you and is incremental because you've agreed in this binding arrangement to do so. I guess the way we'll have to think about principles when we're writing it, though, is that there may be cases where, say, if it's not a hospital, but you're getting a grant, but then you're just spending it internally for, say, training of certain employees, but you're not actually hiring any external educator to come in to actually train your employees, you're just getting someone internally to provide that type of training, then that I think is a case where it just becomes a little less clear. To me, I think this discussion really points to the possibility of including one or two examples in the IPSAS eventually, just to make sure that we are giving a bit more clarity on how the principles would actually be applied in different scenarios. As Ian mentioned, capital grants is a really important piece. So I think this will be something we should just connect on further in the future to make sure we get right.
Okay, thanks for that. And thanks for the sort of checking your understanding, Renee. I think that's probably helpful for the board. So go to Mike, then Mark, then Patricia.
Thank you, Chair. So I had my hand up because I was going to make the same points that Todd and Renee have already done. So I won't go there, but I left my hand up because of Ajit's intervention again. And it was the very example that Ajit provided that resulted in the board in Australia having the exception for capital grants. So if Eileen's going to research that, she might want to have a look at that exception in our standard 1058.
Thanks, Mike. And just a reminder, though, some of that, in looking at that, obviously Australia has a different configuration in its standards and very much has an IFRS 15 based standard, which is sort of, so we need to take that into account, but it's useful to test our thinking on that.
Yeah, look, you're right, but our 1058 was aimed at the public sector, so you're right.
Yeah, okay. So Mark, then Patricia, then Lynn.
I'm generally comfortable with the wording proposed by staff. Concerning the comments that have been made, I think first the capital grant example is always a tricky one because, as it said, it's a special case, and I think it's difficult if we start defining a principle coming from a special case. And why is it special? Because it obviously also depends on the binding arrangement concerning the capital grant, because it can be that the performance, the obligation is to build, to construct it, but you could also see that the obligation is to use it in a specified matter, and then you will have the depreciation that is your cost to provide a service, actually. And I think we discussed this years ago already in the board, and I think it once again shows that we need to remain principle based and depending on the binding arrangement in the respective jurisdictions to leave it to the judgment of the entity. I agree that the transfer of resources needs to be there, and we need to define what we mean. In the same case, what do we define with not fulfilling the obligation? Obviously, an entity must be able to know what are the steps, what is the performance. It needs to be specific enough, otherwise you cannot determine you're not fulfilling your performance or your obligation in this case. But again, there I would caution to be too much prescriptive, because we need to take into account again the various arrangement around the world. Thank you.
Thanks, Mark. So go to Patricia and then Lynn.
Thank you. About the last question from Renee, I think the transfer, I think it's necessary to think more about this, but the transfer of resource occurs in two situations: when the entity fulfills its obligation, or to return the money for the transfer provider. Initially, it's my think about this, but my comment here is in relation to the recognition of the liability, because liability is a present obligation, and a present obligation exists as a result of a past event. And when we analyze the past event, I think in the case of the binder arrangement, we should analyze in two steps. The first step, considering that we agree with the executory contract principles. The first step is when the entities or when the both parts enter into a binder arrangement. In this case, it's necessary to analyze if the terms of contract is favorable or unfavorable. If the exchange is on terms that are currently favorable to the report entity, in this case, when we are discussing liability, if it is on terms that are currently unfavorable, it is a liability. But it is specific in the inception of the contract. And it is related to onerous contract. Sometimes to terminate the contract, the entity needs to pay penalties. I don't know if pay penalties is correct, but have penalties. Then in this case, it's onerous contract because this is unfavorable. And in this case, the entity may recognize the liability. The second moment is related to the obligations or that are interdependent. In this case, when one part fulfill its obligation, in the case when the transfer provide or transfer recipient receive the money, it creates a new obligation to fulfill its obligation, the recipient transfer obligation, or to return the money. Because this, I think it's necessary to divide, to split the analysis about the past event into moments. And I think it's helped to understand the application of the principles about executory contracts. Thank you.
So, Eileen?
Thanks, Ian, and thanks, Patricia. I do agree. I think there are multiple moments really in every revenue transaction and even transfer expense transaction where we need to assess whether a liability might exist. So for example, in the first step that you mentioned, you might have an onerous contract, and Paul has presented some additional guidance that we would be adding to IPSAS if the group agrees, that would sort of help to kind of cover that as well, or bring some color to it. The one thing that might help to clarify here is that the paper itself is actually trying to focus on when a liability exists in the second situation that you mentioned. So where you've already signed, yes, you have the executory contract accounting principles already being applied, but then one party has actually started to fulfill, and therefore the liability that we're speaking of in this analysis is actually the deferred revenue liability itself. So I agree with the points that you've made. I just wanted to make sure it's clear that what we're trying to really round out here in the analysis, and what we'll speak to a future piece of guidance in the IPSAS, is about kind of that second step that you mentioned in your intervention, where there is actually a liability associated with your obligation because you've already received resources from the transfer provider.
Thanks. So I think, in terms of the principle, in terms of that second event, Patricia, I think you're happy about that, if I understand you right. But we need to make clear in the drafting that actually you have that first event, which is entering into the binding arrangement, and that's what could give rise to the onerous contract at that point, and therefore a liability through that being onerous. Yeah.
Yes, and in connect with this, the use of the past obligation. I think the use of the past obligation is not appropriate in the draft. In some paragraphs, not in all, but in some paragraphs. Yes.
Yeah, I mean, I think that's where it's a classic example of we need to bring down the principle that's now in the liability section into the guidance, and it may well be that this is a combination of authoritative text, but also with explanation, implementation, whatever seems appropriate. Yeah. So I think that's the instruction, to make that clear for staff when they get into drafting that sort of stepped approach, and that's how it would work in practice. Lynn?
Thanks, Ian. And I think
I wasn't going to put my hand up because I was agreeing with points that have been made before, particularly by Todd and Renee. But one thing when Todd was speaking, and it came up in Renee's commentary as well, but also generally, is we will need to use examples here. And I guess the principle that I wanted us to be clear on is how much liability do you have and recognize? Because I think we potentially make an assumption that the revenue and the penalty or the return matches our delivery of obligations, but it may not. So say, and I'll at risk of adding another example to the discussion, say you have a hospital that gets paid if it admits and treats a patient, but only gets penalised 10% of its income if it admits but doesn't treat the patient. If at the year end it's admitted a patient, but actually all its costs associated with that income stream are in the treatment of the patient, not the admission of the patient, does it recognise 50% of its income because it's done half its obligation? But actually it may only ever be penalised 10% if it doesn't then treat the patient, which is where all its cost base may be. So I think we do need in the examples to say, in that scenario, do I recognise 90% of my income on admission because I'm only ever going to return 10 if I don't treat, or have I fulfilled 1 out of 2 obligations? So I think we need some examples that help our preparers know what we mean in terms of the extent of liability we can defer revenue for.
So Lynn, can I propose we take that forward as, because essentially I think what you're talking about there is how you componentize the transaction. And it does seem to me that actually what we're going to need to do is build off some of the guidance, for example, in unit of account, in terms of thinking about that componentization. And I think there is an instruction to staff that we will need a paper on that issue, because it's about how you pick up the various different components and therefore, what is recognized when and so on. And then I think that will lead us on to the discussion about the examples. So if you're okay with that, Eileen, does that make sense then as an instruction?
Yeah, I guess the one thing, and this is preliminary thinking, just listening to the example, Lynn, that you're mentioning, I think the first thing that strikes me about it is it very much is also connected to how you measure your present obligations and your performance obligations. And I think when we were actually talking about present and performance obligations in March, we did also use the terminology of units of account, because it's a way of thinking about, what are the components within your revenue binding arrangement, and how you then recognize revenue there. So the slide that we also had prepared in terms of derecognition of liability is associated with how you actually fulfill your present obligations, which are also, in a sense, components that you are fulfilling over the life of your transaction. So they are considerations, I think, even on the variable consideration side for the measurement of your revenue, which will be very directly associated with the derecognition of your liability. If everyone's okay, and Ian, if you're okay with us moving on to that part of the paper, then maybe when we present that, it could give us some clarity on whether, if we think the principle is still right in terms of how we derecognize a liability, then maybe this is a matter of what can we do with the drafting after coming out of this discussion to make sure that we capture both the initial recognition and also the subsequent derecognition and measurement appropriately for both revenue and the liability associated with the deferred revenue.
So I think if I can just sort of summarize where I think we get to, I think in terms of the overall principle, members are content with that, but it's subject to particularly the drafting on enforceability. I think it's clear that we are going to need that additional paper on that unit of account componentization piece to feel comfortable. There certainly is thinking to be done about which examples we need. And there is also to test the drafting that we've agreed in terms of the additional material under liabilities using the capital grants example. I think most members are in the camp that actually that does satisfy the example that actually quoted, that would satisfy transfer of resources, but we just need to test that to see if there's any lack of clarity in that. Okay, everyone okay with that as a summary of where we've got to and the way forward? So then Eileen, move us into the next part of this.
Thanks, Ian. So the next slide is quite simple, and I think we've kind of already touched on it, so I won't be too verbose with it. After initial recognition, the deferred revenue is essentially reduced over time, or at a point in time, fully extinguished when the transfer recipient fulfills its present obligations associated with the resources previously received. And so the transfer recipient is essentially going to measure their progress to determine when they actually earn revenue by fulfilling its obligations, and thereby decreasing the liability, deferred revenue, to reduce the amount of transfer of resources that they would actually have to transfer out of their entity as the transaction progresses. And so we've presented an illustrative example in Appendix 2 just to show how accounting entries may look in those circumstances as they progress towards fulfilling their present obligation in the binding arrangement. But I'll take down the slide and pass it over to members to see if they agree that the derecognition of the liability, i.e. deferred revenue, is based on the the fulfillment of the present obligations over time.
Thanks, Eileen. So open up or reactions from members. So I'm not seeing any hands raised, so I think that indicates people are content with that approach. I think that does solidify the discussions we've been having. Okay. Good, so move us on.
Great, thanks. So the next piece is the existence of an asset in binding arrangements, and I'll turn it over to Paul. Let me just share my screen as well.
Thanks, Eileen. Good morning, or good afternoon, everybody. One of the key questions in the development of ED 72 transfer expenses was whether a transfer provider has an asset where it has transferred resources to a transfer recipient prior to the transfer recipient fulfilling their obligations. So it's sort of the reverse of the scenario we've been talking about in the liability paper. It's when the transfer provider transfers those resources up front, is there an asset for the transfer provider? And as we just talked about in John's session earlier, an asset is defined as a resource presently controlled by the entity as a result of past events. ED 72 concluded that the transfer provider would have an asset where the transfer recipient has a performance obligation, i.e. that requirement to transfer goods or services to a third-party beneficiary, but that the transfer provider would not have an asset where the transfer recipient had a present obligation rather than a performance obligation. And a significant number of respondents questioned that conclusion and that the resulting accounting treatments that were proposed in ED 72. Respondents raised questions of principle that are considered in this paper. In April, the IPSASB instructed staff to assess whether the transfer provider's right in a binding arrangement where it has already fulfilled or partially fulfilled its obligations by transferring the resources meets the criteria for asset recognition in the conceptual framework. So that's what we're going to be looking at in this session. First of all, many transfer expenses will occur without there being a binding arrangement. And in such cases, the transfer provider will have no enforceable rights against the transfer recipient. The lack of enforceable rights means the transfer provider could not control any potential asset. There's nothing there to control. So that's going to cover a lot of the transfers that ED 72 addresses, that the IPSAS on transfer expenses will address, where there's no binding arrangement and no asset. That's not the focus of this paper. What we're looking at in this paper is binding arrangements. So these other transfer expenses that will arise from a binding arrangement are the main focus of this paper. And the question is, which parties have fulfilled obligations? Staff have identified 4 possible scenarios for this, and we're going to look at those sort of individually. First of all, scenario 1, neither the provider nor the recipient has fulfilled the obligations. And in that case, there's no asset. Where agreements are wholly unperformed, there's no recognition of assets or liabilities, as the board has already agreed. Scenario 2, both sides have performed, and again, there's no outstanding rights or obligations, so there's no possible asset. In the third scenario, the provider has yet to transfer the resources, but the recipient has already performed or partially performed their obligations. In those cases, the transfer provider's right has been extinguished by the recipient fulfilling their obligations. So there's no possible asset. And that then leaves us with scenario 4, where the provider has transferred the resources, but it has an outstanding right to have the recipient fulfill their obligations. So the question we're looking at is, does that satisfy the definition of an asset? So starting with this question, the instruction from the IPSASB was to assess whether this enforceable right gives rise to an asset based on the conceptual framework definition. ED 72 identified effectively 2 types of right. The first one was the right to have a transfer of goods or services to third parties, performance obligations in the terminology used in ED 72. Under ED 72, this was considered to be an asset, and the substance effectively is no different to exchange or commercial transactions. There is service potential for the transfer provider, and consequently, staff consider that this will meet the definition of an asset. Second type of right was other obligations, referred to as present obligations in ED 71. These were not considered to be an asset under ED 72, but this view was challenged by respondents. And the next slide will look at whether this enforceable right does indeed meet the definition of an asset. Based on the requirements of an asset, which we've just discussed in the conceptual framework session, key factors are whether there is a resource, and if so, whether the transfer provider controls that resource. Starting with the resource, staff considered the substance of the right. The rationale set out in the agenda item 4.2.2. Staff considers effectively this is similar to goods and services, and that it does provide service potential for the transfer provider. Consequently, this suggests there is the right is a resource, and this is supported by the fact that where there is a binding arrangement that is wholly unperformed, an entity's rights and obligations are treated as a single item, as the IPSASB has already agreed. Looking at control, this is simpler. For a binding arrangement to exist, it must be enforceable. And this enforceability means that the entity will be able to control those rights. Similarly, there's the question of past events, and again, entering into the binding arrangement and the transfer of the resources will be the past events. So again, that's fairly straightforward. Consequently, staff have concluded that the definition of an asset has been met, and that so the transfer provider should recognise an asset. So if we can move on to the next, the first recommendation is that the IPSASB agree that where the transfer provider in a binding arrangement transfers cash or other resources prior to the transfer recipient fulfilling its obligations, the transfer provider's enforceable right to have the transfer recipient fulfill its obligations or face the consequences outlined in the binding arrangement meets the definition of an asset. At this stage, we're just looking for the agreement on this principle. As with the previous discussion on revenue, there will be complications around how you measure that, and all of the details around that, partial performance, etc. But at the moment, we're just trying to get the agreement on the principle, because we were aware that this is a change from what was proposed in ED 72 in the case of present obligations, and therefore we need to sort of resolve that principled question first, and then we will, when we're developing the drafting based on that, we will look at all the questions around measurement and everything else. So through the chair, if we can just ask for any comments on this.
Thanks, Paul, for that introduction. So open up for comments from members. So I'm okay. I was okay. So go to Todd, then Mike, and I'll bring Thomas in at that stage.
Thanks, Ian. I thought someone needed to start to make comments on this. I think, Paul, what you've demonstrated here, you know, I would agree with. I don't think whether it's a performance or present obligation that's involved makes a lot of difference to whether or not you've got the asset, so that's good. One thing, again, which I've engaged with you on before this meeting, I think it's really important if we take the perspective of the transfer provider here in terms of it being an asset. And I talked before about, you know, we need some level of specificity in the binding arrangement. I think from a resource or transfer provider's perspective, it's really important that they do have the mechanisms or whatever in place to be able to enforce this contract, so they are actively monitoring what's going on. And I think that's really important when it comes to the perspective that we're looking at here with the transfer provider, because if they're not actively monitoring, they could be recognising an asset and not expensing at the right time, so overstating their asset. So I think it is quite important that we're clear from that perspective that there is that that monitoring, that active monitoring of what's going on.
Thanks, Todd. I think that's really important, emphasising that sort of PFM perspective, and I saw thumbs up in support of that. Mike, and then go to Thomas, Scott, and then.
Thanks, Jen. Thanks, Paul. And I agree with what Todd just said. Thank you, Todd. And the only thing, two questions for me in addition to that was, can we actually make a decision here without looking at 4.2.4, which talks about whether a transaction is with or without a performance obligation? I'm just not sure, Paul, maybe just clarify for me, because I agree with the conclusion you've reached. The second point then was, having concluded there's an asset, the question of how do we measure that asset needs to be considered, but I'm not sure whether we need to do that now or not.
I think, as Paul has introduced, we're not on measurements at the moment, but perhaps you can address the first point, Paul.
Yeah, I think I think actually it's the other way around, Mike. If the board agrees there's no asset for present obligation, but is an asset for a performance obligation, then I think you have to say, well, actually there is a difference between performance obligations and present obligations. If you agree there's an asset for both, then you've got a decision to make as to whether there is a difference between present and performance obligations. So I think 4.2.4 relies on the board having agreed there is an asset for present obligations, and then there's a question of whether there are any other differences between present and performance obligations that need to be brought into transfer expenses. But I don't think it works the other way. It's necessarily the other way around.
Great, thanks for clearing that up. Okay, so go to Thomas and then Scott, Lynn and Mark.
Yeah, thanks, Ian. I raised my hand in the absence of any other reaction, so I thought I would fill the gap, but now I see there is no gap. But
exactly, that was why I thought it was time for you to come in, Thomas. So.
Yeah, I know. So apologies for kind of jumping into the discussion, but I think I found the analysis very convincing, and thanks, Paul, for the great presentation, very structured. I think the only weak point is where I kind of read the examples in cases where the recipient has no performance obligation, but another present obligation. Why and how does the transfer provider gain service potential from the fulfillment of the obligation? I think that's not, it's not explained and it's not obvious. Let's assume the present obligation is a reporting obligation, like the cases we heard from the European Commission. So I think it's not immediately clear how from the fulfillment of the obligation the provider gains service potential. But it's important to come to the asset. So I think just help understanding that a little bit better.
Thanks, Thomas. Paul, do you want to come back on that before I go to Scott?
Yeah, I mean, I think we've put a few examples in the paper which were relatively straightforward. There are obviously more complex examples, so I agree. I think the reporting obligation is one where it's going to be more difficult to demonstrate service potential. I think you probably can in terms of saying, well, actually, you're actually demonstrating that you've got value for money. But I think it is an area where we're going to have to do more work on that. I think it will also cross over into measurement, because when you're trying to allocate amounts across various performance obligations in the binding arrangement, what's the value of the reporting against the value of what else has been done? So I think there's going to be a crossover into measurement there as well. But yeah, I take Thomas's point. I think there is more work that's going to need to be done in drafting and in the examples in making sure that we can clearly demonstrate where service potential is being generated.
Okay, thanks, Paul. So I think you've just written the instruction there, the staff. So if I can then go to Scott, Lynn and Mark in that order.
Yeah, thank you. And I raised my hand because I wanted to speak in support of it. What I liked about it was the fact, one of the comments we were hearing was that the other answer was too complex and it was going to be hard to implement. And what I liked about this is it's very practical and very implementable. And I think that's important as we go through with the concept, is to have something that, we can implement. And I saw that coming up this way would be lots easier for the government transferring the resources to figure out what's going on. The other one was going to be very difficult. So I wanted to speak in support of it.
Thanks, Scott. And I think that's probably important to capture in the basis for conclusions, that sense in terms of thinking and the response to what constituents have raised. Lynn, then Mark.
So I guess my comments link to what Todd said, which is the question that begged to me when I read the paper is, what if you don't know? What if you don't monitor? What if you don't know the degree of the recipient meeting their obligations? Are you able to measure the asset? Do you have an asset? And I think we do need to be clear. Maybe that's through examples or guidance, but I can think of many examples where we don't monitor, or we don't know sufficiently, or we might know when they've discharged all of their obligations, but not when they've discharged part. And I do accept, Paul, that you said you'll need to come back and look at sort of partial completion of obligations. But I just felt what was missing for me on the paper was I can agree to this in principle in scenarios where there are tight binding arrangements with clear obligations that are monitored, but it still left me a big gap about what if I don't know? Do I still have an asset or not? Do I recognise the spend immediately? And then just hearing the conversation, I think it was Thomas's point around the service potential and being able to articulate that to convince myself I've got an asset. I guess you could have binding arrangements that where actually the service potential I'm getting doesn't match the amount that I'm going to pay out. So I have an onerous binding arrangement, not in the traditional sense of an onerous contract that is a commercial contract that's onerous, but what constitutes an onerous binding arrangement in terms of service potential, such that I have to recognise spend now and have a lesser asset. Now, I can take the argument that all of what I'm saying is about how we measure the asset, but I do think we need to cover the what if I don't monitor very closely, and also when do I have an onerous binding arrangement in service potential.
Thanks, Lynn. I mean, I think brutally, if you haven't got sufficient in the agreement and you don't have the processes in place to monitor, it's expenditure. I mean, that, that's the default. And I think that's quite a hard message, but actually it kind of comes back to the whole PFM thing, that actually, really you want people to monitor their arrangements, and if that isn't sufficient, then it's expenses. And we're just being clear about that, which I agree with you is the drafting. And then your other point, I think you're right, is measurement. Sorry, I'll let you come back on that, but I think that's being blunt about it. That's probably what we're about.
So we might sit around this table and think that's what we're about, but there are so many agreements that are time-based, and are we going to allow people to make time-based assumptions?
Well, I think that's a different issue, but it does come back to, and we'll have some of those discussions in December around some of those things around eligible expenditure and specified activities and so on. But I think there's a general point, which is if it's not clear, then actually it's expenditure. So I think that's the test, is actually, it comes back to that. What is it that justifies deferral rather than immediate recognition?
So I hear that. I think we're going to have to be very crisp in our drafting to get a scenario where people who are giving multi-year grants that might only monitor at the end, where does that leave them?
Well, I know where I think that leaves them, but I agree with you. We need to be clear about this. But I think we shouldn't shy away from the fact that this comes back to PFM controls. And if you're not monitoring, you've got expenditure. Ross, and then we'll move on.
Yeah, just to acknowledge a point that's come up through this project for a while that I think we need to make sure we don't lose in finalizing the standards, is that entities might need to think about how they draft their agreements going forward from a PFM perspective. And I think we need to make sure we're capturing that aspect that I think Lynn's bringing up now, that multi-year grants and things where people are monitoring at the end, that might not be good enough to get the deferral they might think they get. And I think similar to when IFRS 15 came in the private sector, entities had to change their behaviors. They had to think about how they draft their agreements. And I think promoting better PFM shouldn't be something we shy away from, and advocating for that. So, I think, Lynn, your point's a clear one. As we draft it, we're going to have to make sure we're clear, but we shouldn't lose sight of what we're trying to do here by the fact that there are agreements that aren't written in a way that's very helpful for what we're trying to do now, and we should encourage people to think about changing their behaviors.
Thanks, Ross. So Lynn, I mean, I think it does all come down to enforceability, really. You okay that we move forward? I mean, you know, we're going to have to be clear about this from a communication point of view, but we do think we have to be quite blunt about it, that if there's doubt, then the default comes into play.
So the point I was going to make is around the comms on it, and giving plenty of notice that that's what we mean, because I think we need to be both clear in the drafting but clear in the communication that goes with it, so there's no doubt about what we mean.
Absolutely, yeah. Okay, thanks for that, Lynn. And I see thumbs up on that. Okay, so let's go to Mark and then Patricia.
I agree with the analysis in the paper that we should not differentiate between performance obligation and present obligations or other kinds of present obligations. It was always clear for me that the wording performance obligation stems from IFRS 15, which encompasses the transfer of goods and services. But in the public sector, we also have different transfers. We can think of transfers of funds, for example. And we even can have hybrid transactions. So if an entity is forced to transfer funds, but first to perform a service to find the eligible persons to transfer the funds, which is, for example, on the state level, I think then it would become even more difficult to separate these two issues. So, and I think it was laid down very well in the paper that both can include service potential. So if there is a question for examples, I think we can also think we have some examples in Switzerland, but I think it is definitely worth bringing up examples so that the stakeholders know what we mean. Concerning the point of Todd has initially raised and has been discussed, the monitoring, I fully agree. It is more difficult from the provider's perspective to assess whether it's performed or not, and to what extent it's performed. And I would also support that we put more thinking into it, whether it's an issue of measurement or whether it's more of what we initially proposed in the drafting, intent to monitor, something like that. I'm open to it, but I would equally support, given that the information for the provider is further away than from the recipient.
Thanks, Mark. So go to Patricia next.
Thank you. About the Thomas question, I think here we should analyze in different way. It's in the case it's the transfer provider transfer the resource, but continue to control the resource. This resource has the service potential, and not the, for example, in the case of the construction of a hospital, the transfer transfer money. The money is the asset for the transfer provider. The transfer provider continue to control the application, the use of the money. And then it's important to identify the moment that the transfer provider decides not to control more. Consequently, the kind of monitoring rules that the arrangement encompass. It is my maybe it's help to understand the potential services. And in this case, I have a comment in paragraph 31, the last line, in relation to the construction of an asset. The moment that the transfer provider decide to not control or control until the certain moment. For example, it's only after to construct the transfer provider decide not to monitor more, because the objective is provide better infrastructure. For example, the object of the transfer provide. Maybe can it's my initial think about the potential services for the resource transferred.
Thanks, Patricia. Paul?
Yeah, a couple of things. I think what we starting with the transfer of the cash. I think if you've transferred the cash as the provider, but you still control it, then effectively you have an agency arrangement, and I don't think you've actually performed on your binding arrangement at that point. If you still retain full control of the asset, then as we discussed in the conceptual framework discussion on an asset control, if one party controls it, that means another party doesn't. So if you've physically transferred the cash but you still control it, then the transfer recipient doesn't control it. So they've got no possible revenue at that stage, and you don't have an expense because you still have the same asset. So I think if you've still got that level of control, you're still at the stage where neither party has performed. In other cases, you may have transferred it, and you've still got and that's what we're looking at, where you have transferred it and you no longer control the cash. Do you have another asset instead, which is typically the right to enforce performance, or should that performance not happen, then you're going to get the cash back. So I think there were two different scenarios there. Thinking about the service potentials associated with capital constructions, the example in the paper is a very clear one where you've actually got an interest both in the building being built and then being subsequently used, because I think that does more clearly demonstrate service potential than if you're just talking about the building being built and then that's the end of the obligations. I agree it's more difficult to demonstrate service potential in that latter case. And that's partly why I chose the one I did, where it's clearer, because at this stage I'm trying to get agreement of the principle that there is an asset, and then if there are exceptions to that in terms of not having the service potential in certain cases, we can look at those as in detailed drafting later. But it is an area where we will need to think about what is the service potential if it's just building the building. But at this stage I was looking at just getting the principle agreed. Okay.
Thank you, Paul. So go to Lindy, and then final comment from Thomas, and then I think that will be the end of the session today. Lindy.
Thanks. So I was also going to say that if you control the cash, it's an agent principal arrangement, and so it's not in this. I do think there are. I mean, I can see the argument, but I think there are going to be challenges to kind of justify or to put those yes, but in these instances you don't, or you do have service potential, and how it's going to be measured. And I actually do wonder if it's just easier just to expense in both scenarios, because I do think it's going to be quite a challenge to write the text to have this asset, and it might at the end of the day be such a narrow subset of I don't know, principles or requirements that I don't know if it actually covers a lot of the agreements, but I suppose let's see where we go.
Thanks for that caution, Lindy. Thomas.
Yeah, thanks, Ian. I just want to build on Patricia's comment regarding the last sentence in this example number 3. And actually, this example, and probably you remember that, Ian, was kind of extensively discussed at the IPSASB working group meeting in Rome when we discussed capital grants and when do you release a liability? Is it when you kind of acquire the asset or when you use the asset for service provision? Because in not nearly all cases, I would say, in the public sector, if you provide a capital grant, it's in the end to increase service delivery. The question is it explicitly mentioned in the binding arrangement? And therefore, I'm not so sure whether the example number 3 is really clear enough, because I guess, against the background of the discussion at the IPSASB working group, people would be a little bit confused reading the last sentence. So we have to be very careful with that.
Okay, thanks, Thomas, for that caution. So, I mean, I think sort of, broadly, I'm hearing support from members, but again, this is about the enforceability, and probably thinking, and this I think goes to Lindy's point, which is what is it that justifies deferral of the expense here, and almost it's thinking about it in those terms and drafting in those terms, which then starts to get you into some of the issues that members are being concerned about. Clearly, we will, what we're trying to do here, as Paul said, is get the principles agreed, and then we'll see the drafting and be clear as a result of seeing it down what is required by way of examples, implementation guidance, and be very careful on that, because as ever, it's always possible to come up with more examples, and then we're writing rules before we know it. So we will need to be judicious in the implementation guidance that we give and implementation examples, and in that order, I think. So Paul, I think that probably gets us to the right point for this morning. Anything else on that particular item?
No, I think that's everything. I think the issues I've picked up are the monitoring is clearly an issue. And I think we are aware of that. Effectively, what we've been looking at in this session is the first recognition criteria for an asset, which is that an item meets the definition of an asset. We've not looked at whether it can be measured reliably, which is the second recognition criteria, and that's where the monitoring will come in. So that will need to be looked at. The level of monitoring and what the monitoring arrangements need to be will, to some extent, depend on the accounting models that the board agrees. That's going to be dependent on the discussions and agenda item 4.2.4. So it's not appropriate to get into the detail yet, but we are aware that it needs to be in place. Also aware that there was a lot of comments from respondents about the proposals that we had for monitoring performance obligations being almost unworkable from the transfer provider point of view because you were too far away from the level of detail that we were asking for. So we need to balance something that's practical, at the same time gives you enough information to say, yes, I still control the asset, or no, I don't. So that will depend in part on the arrangements, but it's something we need to pick up. And then we need to look at the other measurement issues, whether you have service potential and how you measure that service potential, whether it's onerous or not. So I think those were the main issues coming out of that. But the principle, yes, that if you do have these arrangements, they can give rise to an asset. I think generally picking up agreement on that.
Okay. And we have one final recommendation, but I think we're going to pick that up as the first item tomorrow morning, or tomorrow, I should say. So, Mike, is it a very short query? Yep. You don't want to get into the final item?
Yeah, I don't want to just delay it any longer, but I always remember this question of monitoring, Ian, when we had a presentation from a lady from the European Commission some years ago, in how they monitor the performance of the various EU countries when grants are given, and they monitor it very strictly, and maybe there's some examples we can draw from that.
Yeah, thanks, Mike. And staff are very closely in contact with the European Commission on that. Okay, right. So I think that's the point in time at which we should wrap up for today. I am conscious there is one final recommendation, but I don't think we have time to debate that today. So we'll pick that one up first thing tomorrow morning. Tomorrow, I keep saying morning, it is morning in the UK, but I recognise it's certainly not if you're in New Zealand, for example, or elsewhere. Ross, anything administratively we need to pick up in terms of before tomorrow?
Just one item to flag for members, and that's depending on how we progress through the material tomorrow. If we do proceed quickly, we've got a whole session for the remaining revenue and transfer expenses papers. Then we will move to leases if we have additional time tomorrow. So on the staff side, we're ready to go, and Lynn's aware that we might get into leases if we finish quickly. And I just want to let people know in case they want to arrange their papers or, be ready for that, just a heads up.
Thanks, Ross. And we probably shouldn't tempt fate on that, but if you can bear that in mind in terms of your preparations for tomorrow, that's very helpful. Okay, so thanks everyone for today. Range of good interventions, good support from staff, I think. So thanks everyone, and look forward to seeing you all again tomorrow. Thank you.
See you. Bye.
Thank you.